I want to get now to our next guest, who manages billions of dollars in fixed income investments. He is David MacEwen, the Chief Investment Officer at American Century. In fact, manages $30 billion in fixed income and money market assets. David, thank you very much for joining us. Sara is with us as well, and Dom in just a few minutes is going to be joining us. But, you know, David, we're just coming into you after hearing from Senate Majority Leader Harry Reid. You know, they've got to get this package together. You yourself, what are you pricing in, seeing what is going on in Washington right now?
Well, it's a very difficult time given the budget negotiations. It's the range of potential outcomes for the market and for the economy are so broad, from interest rates skyrocketing to interest rates plummeting and kind of everything in between. So it's we don't think it's a time to take a lot of risk in your portfolio. So we're fairly close to benchmark right now, and not looking to add a lot of risk until we get some clarity about where we're headed.
Hey, Dave, it's Dominic here. One of the things that you run a very large fund complex here, a lot of mutual fund money, bond funds, so to speak. Now, are you seeing any kind of investor jitters here? I mean, are people pulling their money? Are you seeing redemptions out of your funds, even though it's bonds?
No, we're not seeing redemptions out of the funds at all. I think investors are taking a wait and see attitude and see where we're headed here. It's very difficult to even know where to go. I mean, the traditional move would be away from risky assets into risk-free assets. Risk-free assets being treasuries and agencies and those types of securities. But in this environment now, the treasuries and agencies are where the difficulty could be. So a move into those assets isn't necessarily going to look smart potentially as we go down the road. So really, investors are just waiting to see which way this goes.
David, the 10-year Treasury yield right now is trading at 2.9%. How far down does it have to go before it's pricing in a double-dip recession?
Well, you know, given the GDP numbers we saw this morning for a weak second quarter and even a weaker first quarter than we thought we had, the effects of QE2 rolling off, and whatever we get out of Washington here is likely to be a contractionary fiscal situation. So the second half growth is starting to look fairly skeptical. So it's I think if we had a double dip recession from here, rates would come down significantly more than where we are now. But we're not there yet. We think you know, corporate profitability is still fairly strong. Okay. We believe we will get through these budget negotiations and with some kind of healthy outcome of some sort. So we're not looking for a double dip recession here.
David, let me just ask you this. Roger Altman was on with me earlier, and he said, you know, that he doesn't believe that the U.S. Treasury is going to default on its obligations. He does not think that they are going to prioritize that. But do you think that Treasury bondholders should worry about this?
Well, worry perhaps, but I think at the end they cannot default on their U.S. Treasury debt. It would just be so counterproductive to what they're trying to accomplish in Washington. So I wouldn't worry about it. There certainly is the capacity to pay not only the interest on the debt, but there's a capacity to pay all the obligations of the U.S. government. And when you step back and kind of think about the environment we're in here, it's actually encouraging in that politicians are now taking the budget deficit seriously. They could have just blindly increased the budget deficit and moved on, but they're making the effort to seriously reduce our budget deficit for the long haul, and that's a very healthy situation. That's something we need to come to grips with for a long time. So from that perspective, it's a real positive. So I think as we kind of move forward here, there's very little risk of default.
David, thank you. Appreciate you joining us. David MacEwen from American Century.